Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds to give us 5 stars on Spotify or Apple. This helps us with the search engines so that more folks can also discover and engage with all things microcaps. Registration is open for our next event, the Planet MicroCap Showcase, taking place in Las Vegas at the Horseshoe Hotel and Casino, formerly Bally's, on April 25 through 27, 2023. We've announced initial speakers, companies, sponsors, the whole bit, and I'm beyond excited to see as many of you as possible in Las Vegas. This is an event for the microcap community, and we curated it with you in mind. So please, if you can make it, we'd love to have you there. We're going to have more announcements as we get closer. You should hear some of the conversation I'm having with some potential speakers actually that might be about to jump on board. So we're really excited about that. And to register and attend, which is complimentary for all my listeners here at the Planet MicroCap podcast, please go to www.planetmicrocapshowcase.com. See you in Vegas. Again, speaking of Vegas, my guest on the show today is Ryan Irvine, founder of Keystone Financial. He'll be joining us in Las Vegas, where not only will he be on the Planet MicroCap podcast live panel, along with Sam Namiri, Harris Perlman, and Matthew Martin, Ryan will be moderating a few sessions with companies that are within the Keystone coverage universe. Ryan's firm, Keystone Financial, is an independent research firm that provides their investors with buy, sell, hold advice on undervalued micro, small, and mid-cap growth and value stocks. As their website states, and I quote here, real companies producing real revenue and earnings growth, trading at low prices, end quote. In our conversation today, we dive deeper into Keystone's investing strategy, plus a quick overview on 2 of the companies that Ryan will be doing fireside chats with: Envela, ELA on the NYSE American, and GEO.TO, GEO on the TSX. Thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Ryan Irvine. Ryan, thank you for joining me today. How you doing, man?
I'm doing really well. Just going over a ton of companies right now, prepping for your event we're coming up to in Vegas now. So it'll be great to talk to some people in person, bring in a couple companies that we have in coverage to show kind of people in the U.S. market what we look at when we look for companies. And these are some of the good examples. I'm not going to call them our top tier list, but I think that's already been taken. But maybe we'll call them some of our top buys, right? I've heard it's been taken. Our top buys that we're looking at right now. Yeah, just good examples of the quality type GARP, growth at a reasonable price businesses that we look for.
Awesome. Well, Ryan, we're so pumped about it. And yeah, that's literally why I wanted to bring you on here today was, shamelessly not only plug our event, because I can't help myself and do it whenever I can, just putting that out there for everyone.
Right.
As you should. Planet MicroCap Showcase, April 25 to 27.
It's all you got, so you got to do it, right?
I got to do it.
It's not all you got. There's way more to you.
I have my family in Vegas. Yeah, that's it. Okay.
It's the same with me. Although I'm going to Vegas to get away from the family. I'm kidding. Is this being recorded? Now I'm in trouble.
No, you're doing that to get away from the new puppy. That's really what it's about.
Yes.
That's
great. We just got a golden retriever. So it's 14 months old or weeks old. I wish it was 14 months already, but now 14 weeks, and it's a little crap show. She's had diarrhea since day one. It's been amazing, and I'm sure everybody wanted to know that, but I like to tell people about my dog.
We like to make sure that everybody has a little, glimpse into, our speakers and us, our personal, we're not just robots that pick stocks, you know what I mean?
Yeah.
Like,
oh no, it's true. I think that's enough that they need to know about me. I'm kidding. If you want to know more, I hate my local Canucks too, but I'm a hockey fan. So anyways, that's enough.
Oh man, well, it's too bad you're not a Rangers fan right now. We're pretty happy. But anyways,
yeah. Well, let's not talk Rangers, because the last time the Canucks were in the finals, we played, against. Well, actually, it was Boston. Before that, sorry, and we lost to the. We just lose to every team, so it all comes together. 7th game. And lost to
at least you get the iconic
Messier run team.
But at least you get the iconic photo, right? You get that iconic photo in the street of, the couple kissing, commiserating over the loss. Like, that's
with
nice.
The burning city.
Yeah, with the burning city.
We burned down the town twice. Oh, let's not talk about Vancouver and sports. It's ugly.
For sure. Let's get into Vegas and stocks. That's way more fun. Nice. So like we said, nice transition, right? Like we said, Ryan's going to be bringing down. He's going to be bringing down some companies that are within the Keystone financial coverage. So I thought today what we would do is, go into a little bit of Ryan's criteria, what he looks for, what it means when they are take positions in some of these companies, and then maybe preview a few of those names here as well for folks to get a better understanding. So, Ryan, to start off for you, what is I'm not going to use what we're calling for Maj's, the top tier, but for yours, what is some of the criteria that you're looking for these companies that you have under coverage?
Yeah, I'll just tell anybody who's watching what we're a fully independent research firm, been around for 24 years. Clients are individual investors, institutional investors. They pay us to help them build simple 15 to 25 stock portfolios. We look for stocks on a GARP basis. So that's our criteria: growth at a reasonable price. We're sector agnostic. And let me step back and say, when we're independent, companies cannot pay for coverage in our research. Our clients are individual and institutional investors that pay us. So we look for growth at a reasonable price. We're sector agnostic. We really believe our edge essentially is that we leave no stone unturned in our research. We put actual eyes on the financial statements of basically every stock in Canada that's over 3,500 approximately, and 3,400 in the US on an annual basis. So I'll start with our process. It's really simple, but it's a lot of grunt work, and I think that sets us apart. About 25 years ago, I read an interview with Warren Buffett on his process. He was asked a simple question, because I was starting out at that time, and I thought it really spoke to me. He was asked if he was starting out as an analyst today, what is the best piece of advice he would give anybody starting out? Essentially, he said, start by going through every stock in the country. Well, I remember hearing and seeing the interviewer laugh and say, well, that would be over 10,000 stocks. That's ridiculous. And Warren just deadpanned him back and said, yeah, I would start at the A's. And that's what I did. And so that stuck with me. And we started doing this 20 plus years ago. We would sit down, and you guys have Edgar in the US, and we have CEDAR, SEDAR in Canada, where every company files all their documents. So we put this into process. It takes us about 2.5 months. So on our analyst team starts at the A's, on CEDAR, one starts at Z. We meet in the middle, and we just go through every public company's documents. So we start with the financial statements, right? You look at the income statement, latest quarterly statement on every stock. Unfortunately, really in Canada, fortunately, it helps us move through a little faster. There's a lot of resource companies and a lot of oil and gas that are exploration stage. So we don't even have revenues. So you just swipe right or left or whatever it is on the dating app. I'm not allowed to know that now. So let's just, whatever way you get rid of, we get rid of companies that way. We move on to the next company. If it actually has revenue, right? We go from there and say, is there growth? And then go down to, is there income, cash flow on a per share basis? We like to look at balance sheets too. So a strong balance sheet or net cash position is something I love in a small cap, particularly where the volatility is higher. If you can't always have that, you got to be able make sure they can service the debt, particularly in this environment. Now, then we rank these companies against each other. We pull every week the companies that our analysts have pulled out after reading outlooks and all those things. I don't want to get into the exact formula that we have, but we have an investment meeting every week, and we go over who we're going to interview, right, from that list. So after we get through the 3,000 companies, we're going to go through and interview management teams. You want to talk to we always want to talk to the CEO. Want to talk to, if there's a shareholder that has a significant position that's on the board, you might want to talk to them, and then just and go through whether or not they fit that criteria of growth at a reasonable price. Figure out if they have a growth path ahead of them, looking 3 to 5 years, because we're not buying the stock for what they do over the next 6 months. It's always 3 to 5 years plus. We'd love to hold them for as long as possible. But you want to have a growth path that's reasonable ahead of them and have a reasonable price. We also need to understand the business. Since we can understand the financial statements, but if we can't understand, there's some statements that are ridiculous for us. And if there's any hesitation there, we can move on to the next company, because we look at so many companies that you want to find the best out of that. But if you can't understand anything, we just move on. So we do a similar thing in the US. We're actually doing that right now. We don't start at A and Z, or whatever way you want to flip it, A and Z on Edgar. We're doing right now something, every stock under 100 billion, or 1 billion, sorry, not 100 billion, or under 1 billion, and just going through that same process. So that would be, we do look on the OTC, but only the OTCQX. Then every stock under $1 billion on the New York, every stock under $1 billion on the NASDAQ, essentially. And just that'll take us, about a month and a half, 2 months to go through. We have 4 analysts on it right now. And every time we have a company come out in our weekly meeting, if we like the business, want to go further, then we're going to go and interview management. Incidentally, I noticed one of the companies that's going to your conference upcoming, Credit Risk, they just popped up on our screens from looking at the actual financial statements, looking at our growth at a reasonable price criteria. And so we interviewed management last week, and then we said, we're going to see you in person, in about a month and a half's time, and at the Planet Micro. So it's nice to see that some companies that we're pulling out just through our independent research are actually at your event too as well. So we'll sit down. We had a good conversation with them. It was good.
You couldn't hear what I said, but whew, that's good.
No, they were terrible. No,
yeah, right.
I'm just kidding.
You're not sure.
For them to even be an interview for us means we've liked quite a bit of the story, right? So, and we've liked quite a bit of the numbers behind them. And then we got to know, it's a father-son team there, right? And we got to know, basically the father quite well. He's a great character, great interview with him.
Oh, character.
And the son seems to be a good executor, right? So it was quite instructive, informative, about an hour and 15 minutes. So we sat down with them, Zoom. But now, the great thing is, when you go to an event like yours, we get to sit down with them in person, and we can do the 30-minute speed dating, and then if we really like you, we can go to dinner with them and really start to explore. So we've done that so many times before in the past. I remember sitting down 5-6 years ago with Ryan Pape from Expel.
Yeah.
And that company's been a game changer for our clients, right? It was trading. It was then listed just on the TSX Venture, right? And in US dollars, about $1.40. We got to buy in, and our clients got to buy in between $1.50 and $1.20. And today it's $64. Like that. We always talk when we do seminars with our clients, and talk just how important the winners are in your portfolio, because you're going to have losers. And if you can ride out those winners, we actually bought more of Expel at $2.50 because their quarter, I remember in March of it's probably 2018, was so good that on a trailing basis, their EPS, their PE on their actual EPS, on an adjusted basis, was better at $2.50 than $1.40 because of the quarter that came up. And then we bought more at $5, and we've bought as the stock has gone up, and just but it's just, well, the business is well executed. I don't know. You probably know Expel quite well.
Oh,
yeah, but
very well.
Yeah, it just, those are, and see, we watched the company for 4 years before we bought, right? So, I mean, very patient on stories like that, got to know the business, had talked to management a number of times. There was, in the fall of 2017, the numbers kind of hid the actual earnings. Like, so when you're actually, that's one of the reasons why we actually want to look at the MD&As, the management discussion documents, and look at the numbers, not just use a screener, right? Because you use a screener, it's not going to see that, this company consolidated 2 distribution facilities, and there's one-time costs in that quarter. Your screener is just usually getting a non-adjusted earnings figure. So it may have looked like that company was trading at 17 times earnings, when really, based on, taking out those one-time items, it was trading at about 10 or 12 times, plus the growth was 30+%, and we thought it would accelerate. So that's where, your boots on the ground, actually looking at the financial statements, looking at the outlook, seeing if these numbers are, on the accounting basis differs from how we'd look at it on an investment basis, right? So, I mean, that's the value of spending 2 months looking at financial statements, and your family doesn't see you, but that's not the best part of it. But you can find in Expel, you can find like these companies that really are orphaned by the market, and then they start to finally get their due. In Canada, on Expel too, literally never had, like, we have 5 big banks, essentially never had coverage from the banks at all, despite the fact that it went on to be, basically, it graduated to the NASDAQ and went on to be, over that 5-year period, the best performing stock from that exchange, right? And it just had cash in the bank, so didn't need financings, thus doesn't get coverage from the boutique brokerages or the big banks, because there's no money in it for them. Despite the fact it should have been in many portfolios, it never gets in because nobody's covering it, because it doesn't, you're not wetting the whistle of a company like that. Anyways, that's kind of our process, doing that in the US right now. And then, I mean, there's a number of other things we look at. You want to judge qualitatively management teams too. So we have a database. When we interview management, if they have guidance, then we look at the next quarter. Did they hit guidance, exceed, or fall below? Now, if they hit or exceed, you're going to give them a check mark in our system, right? And if they do that in the next quarter, they're going to get a check mark. If they continue to do that over time, we have a higher degree of confidence, so we can apply a higher multiple to the stock, right? We're very patient with stuff like that. But if they miss or continually miss, like the opposite is true, we're just not going to be able to put a lot of stock in or credence in anything they say in those interviews. One thing, again, I'm going to pump your tires for having an event like this. We found during the pandemic, when we do a Zoom call or those type of calls, it's not as personal. Management's not as accountable to their guidance. Then if they're going to be on the small cap circuit, we're going to see them at your event, we're going to see them at an upcoming event, and you're going to be able to shake their hand and look at them and squeeze it harder if they miss their target, and then shake it less. You're gonna keep them accountable, right? So it's good, and you can do those things in person, and I do find that those are very valuable, right? And that's why
100%.
we do those events and reach out and be involved, because I like to actually talk to management. In the end, it is their intellectual capital behind the business that you're investing in, and for us to put our money, for us to put our substantial client base's money behind it. It's really good to be able to sit down with a management team and find out if you're comfortable with that person. We've had some conferences. I'm just keep going here. You don't even have to talk.
I was gonna say, dude.
We've had some.
You do webinars. Listen, Ryan, you do webinars, so like I know you're
we
good.
Just did a 5-hour one, right? So like and somehow I was still talking at the end, right? But anyway, but like we've done events like yours, other events all across Canada and into the US, and you'll see a number on our company on paper that everything looks, it looks quite good. And then you'll meet the founder, the CEO, and you will say, I'm not putting my money there. And I'm not going to totally name companies that are doing that right now, but I mean, there are a few companies that we've had like, shit, this looks like great numbers. Everything looks like great stuff on paper. And then I'm like, I'm not putting my money, our clients' money, with that management team. And that's not something that I can just, I can't put that into a spreadsheet to quantify, but you're going to get a feel for and it's just what they say in the interview too, and what they're looking at, what their vision is. But yeah, there's some people you would trust with your money, just like you should trust this advisor over that advisor. It's the management team you're putting your money with in the business, and particularly in the small cap area. Like sometimes you get to a company that's of significant size and they have a massive management team. Well, they're not as important, that one individual, but in the small cap arena, the man or woman holding the reins is often very influential in the business, and we have to be careful who that is, because in the past you get bitten, so you don't want to have that happen again.
100%. You just gave you actually consolidated a lot of great information. I think you should delete that webinar and just take the first 15 minutes of our interview, but that is everything that you look for. But, specifically to Vegas, well, actually, before I get to specific to Vegas, you mentioned Expel and Credit Risk. Are you shareholder in either of those names? I know Expel, right?
We are, but not Credit Risk. We're looking at Credit Risk right now. I think it could be a good counter-cyclical story, and we can't wait to sit down with them. I think they got their quarterlies coming out by the end of this month, I believe. I mean, don't quote me on that right now, but sure. I think we literally interviewed 5 companies last week, and I know 3 of them have quarterlies coming out. We're waiting for those before we're close on a couple companies that we might want to introduce to coverage. Credit Risk checks off a number of our boxes, but we're still looking at it, and we look forward to sitting down with management too. But yeah, we've owned Expel for quite a long time now.
Very cool. All right, so now speaking to the companies that are going to be, and as we were talking, I'm thinking like we call this like the Keystone coverage track or something. I like that. It's got sounds good. But the Keystone coverage track, I think we have a couple names up there right now that I thought would be kind of fun to preview as to why you wanted to have them. Maybe a little couple tidbits on your thesis for why you think these deserve to be under Keystone coverage. So I believe we have GeoDrill, GEO on the TSX, as well as Envela Corporation, ELA. Those are the 2 I got up there right now. So you want to kind of give your 2 cents on each?
Yeah, really interesting, unique businesses that come from our coverage. In terms of GeoDrill, I'm just pulling up. Well, I mean, we could get to Envela first. I mean, I really like this story. GeoDrill's been in our coverage for 2.5 years. Envela is just relatively recent. Entered our coverage in November in the like $4.90, $5 range. It had come down from year highs in the $8.50 or something like that range. It's a re-commerce business, like boring as all hell, really, which we just love these boring businesses. Recycling or reselling of products. They have 2 segments, essentially. It's the DGSE, which is business to consumer, and the ECHG, which is business to business. Now, DGSE is essentially the companies involved in the purchase, sale of jewelry, bullion products, and individuals, consumers, and dealers, institutions under like stores like the Dallas Gold and Silver Exchange, Charleston Gold and Diamond Exchange, Bullion Express. They have 7 of these in total, jewelry and bullion stores, Texas and South Carolina. We expect new stores to be added over the next year. They can do that from the cash that's sitting on the balance sheet. The part of the business that really attracts us, I mean, we think this business can grow, the jewelry store business and the bullion business, but it's the ECHG. That's the most profitable segment. The company is focused on processing, recycling, reselling electronic waste. Customers there would include Comcast, Costco, Verizon, Microsoft, Amazon, NVIDIA, a number of the largest names in tech. It's a very profitable part of the business. We like it. We think it's where the CEO really comes from. That's his background in that business. He owns 70% of the shares, doesn't take a salary. We love that he's aligned with shareholders. But the company's gone from that $4.90, $5 range just over the last 4 months to it's trading today about $7.50 in that range. Why? Well, it's, we've seen growth. I mean, this company has a track record of about 5 years of growth in EPS. Now, just when we're recording this, about 30 minutes before they came out with their year ends, I quickly had eyes on them, but there are some one-time numbers in there. Look like they beat our estimates, which is nice. There's about a 4 or 5 cent gain in the quarter, it looked like. We'll have to confirm those numbers. For the 9 months, the revenues were up 39%. Gross profit was up. EPS was up to about 35% to 36 cents per share. But, growing EPS, like per share earnings on a year over year basis, it shouldn't really take a rocket scientist to figure that out, that it's good for the share price. So this company has taken earnings per share from, I believe, 2 cents in 2018 to we expected 49 cents this year. It looks like they've exceeded that. So we always like to see a company exceeding guidance. Strong track record of that earnings per share growth. We have been cautious in terms of the companies we're recommending right now. If there is a recession, this company typically does better or maintains its profitability. So again, that's a plus, a check mark for the business. There was around 15 million in cash on the balance sheet. We could expect both organic and inorganic growth there for both areas of the business. They're fragmented, significant potential for acquisition. What we've liked about it, and when we sat down with John from Envela, the CEO, when he makes an acquisition, it's very measured. They are not going to buy a business unless they see accretion right away and then growth potential for more accretion in terms of earnings per share. And they're using, cash on hand or debt to finance these. So they're not going to the market and diluting you as a shareholder, which is something we like. We have a fair value right now of around $850. That will likely be increased as we look at what they did in this quarter that just came out, the fourth quarter, and what they're looking at going forward into the year. It's an interesting story. Stock's been on a tear since the start of this year. I'd love to see a pullback, but you can't always get that in a quality story. So when we look at buying a business like that, it's like 3 to 5 years out, we're looking on it. And we like it here. We continue to like it going forward. One thing that's going to hit the EPS this year is just they're going to be fully taxable. They had tax shelters essentially on their income, and that's going to start hitting into the first quarter. So they'll be in the 22-25% tax range, I believe. That's what we're looking at. So if we see 25 to 30% growth this year in terms of earnings, it'll kind of mute the EPS on an accounting basis. I would pay more attention to the operating earnings there. They'll likely go up. It may be an opportunity because, a lot of these stories are not well followed. So if the market sees, they only had a 5% EPS lift, or their EPS was flat in that quarter, or was slightly down. Well, on an operational basis, it should still be up. If there was a pullback, I would take advantage of that because there's a great track record of growth. And, as long as they continue to hit and exceed, and it looks like they did in this last quarter again, they keep checking off our boxes. So we like that.
Very good. And then do you want to give your quick thing on GeoDrill?
GeoDrill? Sure. Yeah. GeoDrill. It's been in coverage since the stock traded about the $1.40, $1.50 range a couple of years ago. It's about the $3 level today. They are an established leader drilling primarily for gold in West Africa, Ghana, Cote d'Ivoire, and Mali. African jurisdictions that they're big in. They're also in South America right now. Their fleet is about 76 drill rigs, could be up to 81 in short order. Good utilization of those rigs, highly profitable, a great operating team, and Dave that runs the business, a tremendously savvy business operator in this region. We like the business. Good growth. Trades it, despite the fact that it's more than doubled in the past couple of years. They've increased their dividend a number of times. It's a small cap in that area, pays like a 2% dividend, which is nice. But generated revenues of about 138 million. That's up 20%. Earnings per share came in at 41 cents. That's US, up from 31. So 34% increase in earnings per share. Now, this company trades in Canadian dollars on the TSX. So 41 cents In US dollars. In Canadian dollars, we're actually looking at like 55, 56 cents. So valuation is about 5.3 times earnings. Undervalued. It is higher risk because of the exposure to gold pricing and the activity in the sector. But, the Major Drilling, which is a company in this sector, the elephant in the sector, essentially, they're expecting growth this year. Geodrill expects growth this year. Likely better profitability than revenue growth. They'll have revenue growth, but profitability should uptick. So, you're paying about 5 times earnings, actual earnings, not like adjusted or anything like that. Under almost 2 times EV to EBITDA. Low valuations is a higher risk sector, but we see this company as actual a takeover target at some point as well. So, we're not always buying. We actually never buy just because a company's a takeover target. We buy because of the valuations. If that happens, it's usually a happy coincidence that'll happen. And we do think that, there is significant profitability in the business, low valuations that could be bought out by a major, not necessarily saying Major Drilling, but a larger company in the sector.
Very cool. And just so that I'm, for compliance, Bob here, just making
we own shares in both. Yeah.
Perfect.
Yeah, we like them both, and have we've held Envelis since the fall and held Geodrill for at least 2.5 years.
Oh, nice little bump on ELA though. That's nice. What
it's
four and change, and now it's straight. I mean,
yes.
recording this on the March 16th. What is that? I just saw it's like 7, just over 7.
Yeah, 750. So
nice.
Done really well since then. It's good, solid business. You keep increasing your per share earnings on an annual basis, and they like 4 or 5 years ago, you back to 2 cents. This year, 50 plus cents. That's why you see growth, and if it can continue, like we would like to model it 20 to 25% EPS growth, looking 3 to 5 years out every year. They could have some lumpiness in there based on acquisitions, but the top shareholder is the CEO. He's aligned with us. Seems to be a straight shooter from what we've seen so far. And we'll be sitting down with him in Vegas again, and hopefully maybe have a steak dinner and see where he's growing the company going forward. But it is interesting. Boring as all hell, but Expel was boring. It really they put a film on cars to protect it from scratches and dings. So, we're always on these panels, and people say, "What's the next thing? What's the next greatest thing?" And I'm like, I don't really give a what's the best thing. I just want to make money, and if this company that puts a film on cars and executes extremely well is going to be the best performing stock over the next 10 to 12 years, I'm going to buy that because I can buy it at a reasonable price. I understand the business; it's growing, and that's sexy to me, not the next sexiest story on the street. So.
It's fun to read page 6 though,
It's true.
Well,
it really is.
By the way, speaking of the steak dinner, I got a couple recommendations for you for any of your folks that are newsletter followers or clients. By all means, y'all are more than welcome to come and
come out. Vegas is a nice city to go out to, right? And it can be fun, and this is a good event. So we'll talk to this about on our podcast too as well if you want us to clip anything out. And anybody wants to join us out there, it's at Horseshoe. I was going to call it Bally's, right? But it is Horseshoe now, right?
They just rebranded, and we also got a special rate, a room block there. And they literally, we were just there like a few weeks ago. They literally just renovated the whole thing, new restaurants, like new everything. It's real nice. And they gave us a sick rate of $59 a night.
Come out, go to a Vegas Knights game or something, right?
Oh, that'd be so fun.
If they're in the playoffs, it might be. Yeah, we'll see. We'll see although they'll be in the playoffs, but like if they get, you got to get to the second round or something. That would be awesome.
Usually they have because we always do it like at the end of April, the first week of May. There's always like either the NFL draft around that time, or the Knights have been good. The Knights have been good.
It's on Thursday, right? The draft, because I'm going to be on my Seahawks. I'm going to be watching. So that's the last night of the event. So we'll be able to watch the draft that night, right? So
cool. That's when I'll be able to like chill and let my hair down and have a beer with you guys and relax. But Ryan, closing thoughts here. Because we're talking about the event. Let's give people a little generalist look as well. You've been obviously you follow quite a few companies. You're also seeing how they've been reporting. We're pretty much at the end of reporting season at this point, for the full year 2022, Q4 2022 results. I asked the same question to Maj. What was your kind of general take of the microcap performance overall?
Yeah, I mean, it's really, thank God it's a market of stocks, not a stock market, because there's some companies that are, in tech, for one, where we're seeing like the macro really hit them. But then there's some individual stories where we just like had tremendous years and like unique businesses, right? I think that there's still, another shoe to fall. Like we follow broader valuations, and right now we wouldn't buy an index. I'm going to buy really individual companies. Like you know the Schiller PE, right? The cyclically adjusted PE, like on the S&P 500. I mean, we follow it all the time, just as an indication of where the broader markets are. Well, right now it's about offhand, I think it's about 11% higher than its 20-year average. I think it's 29. 11-year average is like 26.1. So we just did a seminar. That's how I have these numbers in my head. But yeah, but anyway, so that would be like, to put it in context, right? For anybody who's watching, that's like 38 would have been the high that it hit in November, right? At the peak in 2021. So, that's 47% above the 20-year average. So better than where we were at that time. But I don't just like to look at the last 20 years, because the last 20 years have been really funny. There's been free money, like, money's been so cheap, and we're heading into a different era in that perspective. Like if you look back at the Schiller PE, it's 100+ years it's been tracked. Right now, it's still like 66% above its average, which is about 17.4. So to me, that indicates we're not historically cheap in the markets right now. So I'm cautious. When I went through that process, we're looking at all these businesses on a financial basis, on their statements. We're paying attention. We always do, but to the balance sheet. Like I love companies with rich net cash positions right now, because what that can do is if there is further pain in the markets, or there is a recession, whatever business type you're in, you can weather it. But I don't want a company that just weathers. I want a company that can benefit from it. And if you've got a net cash position, I mean, we saw this in 2008, 2009. We owned a couple software related businesses that had net cash, that were consolidators, that sat there on cash, wouldn't buy in 2006, 2007, right? Wouldn't buy at that time, because everything was just so pricey. Well, we know there's a couple firms we're following again closely that have cash sitting there, and they're just waiting, and they've been waiting for price. Like, tech valuations were silly during the pandemic, right? But they've come down. They probably have another leg to come down, but these businesses can then go out and buy when they're on sale. Like some businesses probably got a great product, but they're leveraged too much, and they borrowed at 2%, and now they're at a floating rate and it's 6 or 7 plus. It's killing their cash flow. And you're going to be able to see those businesses buy those businesses out of cash. They will be the banks. I mean, you saw a massive tech bank fail, right? Like, and these companies that have sat on cash are going to be able to pick up assets on the cheap. And we're kind of looking, I mean, Enghouse is a company. It's a software consolidator, enterprise software, call centers. We recommended them like 14 years ago. They went way up during the pandemic. I mean, they were at $4 then. They're 30 something now. But like they have 270 million or something in cash sitting on the balance sheet. They're just patiently waiting. They made a couple acquisitions at the start of this year, but and they've always grown by acquisition, weren't able to grow during the pandemic because there was nothing they could buy. Now they're going to find some. I would project it's going to probably take another 6 to 18 months to really find that sweet spot for them. But I would rather be that business than, there's business we follow, not in coverage though, they're over leveraged right now, that are just getting slaughtered in the tech sector, and they keep getting slaughtered, and they're trying to come out with adjusted EBITDA numbers and build a case for a multiple off of that, and the market just won't buy it. They want, you want cash flow, but the market is myopic on cash flow per share, earnings per share right now, which we like because we are always, but if you don't have it, these companies are getting killed. They are going to come on sale. Everything was trading in that sector at huge price to sales multiples. We've seen that a few companies that were like 15 times price to sales that are now 0.75. Like, it's come down that much. And like, you're going to pick up some good businesses. These businesses will be able to. So there's going to be real money made. You're going to have to be patient, but we're looking at balance sheets, net cash positions right now in companies that we know that have either done it in the past or we think management teams can do it again. And it kind of excites me because, like, that's where you had a massive run up in some of those businesses. Maybe 3 years out, but I'd rather start buying them today, picking into them than looking at, we're not paying attention to like companies' adjusted earnings numbers. We're doing our own adjustments on them, and you got to be really careful with those businesses now.
100%. All right, Ron, I think we're there, man. We covered quite a bit here.
You think so? You don't want me to blab anymore? You don't? Yeah,
dude, I could talk to you all day. You know that, but I'd rather save some of it for Vegas. You know what I mean?
Let's do that.
Yeah. So Ryan, thanks again for doing this. Where can our audience, right now go and find more information, learn everything there is to know about Keystone Financial, but, become a subscriber, the whole bit.
Yeah. www.keystocks.com, KEYSTOCKS.com. Go there. You'll find everything on there. You can even book like 10-minute calls or something, I believe, with us if you want to talk about how we can help you build that simple 15 to 25 stock portfolio. Unique companies like the companies we talked about today, but we also cover like every dividend stock in Canada. We cover the Alphabets, the Microsoft, like cybersecurity giants like Fortinet in the US. So it's not just the small caps, but we started there 25 years ago. And we have a special area of expertise in that market because we've been looked at all small caps in Canada way too many times. So we know the management teams, where to be and where not to be. It's always a tough area to be in, but there can be those gems that you find that's what we're really looking for to add to portfolios.
1,000%. Well, and again, everybody, you can hear Ryan. He's going to be doing his Keystone coverage. Fireside chats with some companies that are under Keystone Financial coverage that he owns at the Planet MicroCap Showcase, April 25 through 27, 2023 at the Horseshoe Hotel and Casino. For more information, to register, complimentary to attend for all Keystone Financial members as well as verified investors. Please go to planetmicrocapshowcase.com and join us. It's a lot of fun. We feed you like a madman. Trust me, lots of food. And of course, some great ideas and really amazing networking for sure. So with that, come see Ryan speak. I'll see you there in Vegas. Ryan, always a pleasure, man. Thank you.
Yeah, if any of our clients that want to come down, we'd love to see you there. Reach out to us, tell us you're going, and we'll sit down with you at the event as well. Have a good day.
You too. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.